Hello, I'm Greg Bonnell. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis and investment insights, help boost your trading potential. Coming up, we got the Fed on hold, the dollar in flux, the mega cap leadership shifting. Lots going on. We're going to speak with TrendLabs Chief Market Technician JC Parets in just a couple minutes' time. He's going to break down the signals that are driving the markets today. Plus, in today's technical take, we're diving into AMD, the chip giant, reporting earnings next week. Of course, it's on the radar for a lot of investors for clues on what's going to happen, not only for AMD, but for the broader chip sector. That's all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. Half an hour into the trading day, let's check in with the markets. We'll start with the S&P 500. It's got a bit of a downward momentum right now, but the break-even line at the open, and now we're down about 1/3%. We got some tech titans that have reported earnings, a bit of push and pull there. Of course, we had the Fed yesterday afternoon, now on hold. Let's take a look at the heat map. I want to see what's happening with these AI hyperscalers. They're really the focus today, and it's the tale of two hyperscalers, isn't it? We got Meta up 8.5% and Microsoft down 11%, and the rest of the tech space really isn't helping us along. Let's break it down right now. We'll start with Meta. It says it's going to invest as much as $135 billion this year, mostly into AI, well above the estimates I wrote there of about $110 billion. The share is popping because they delivered stronger than expected sales outlook. So if you're going to spend big, like the hyperscalers are on AI, you better have something to show for it. That brings us to our next name, Microsoft. It is moving decidedly in the other direction, as we saw on the heat map. It is also spending big on AI, but now you got to show us something, right? Cloud growth slowing in their second quarter. The market doesn't like the sound of that. A bit light guidance as well for their operating margins. And right now that stock is getting sent lower, and the rest of the tech space sort of more on Microsoft's side than Meta's today. And that's your market update. Joining me now from London, Ontario is my colleague Hiran Amin from our direct investing educational team. And from Lehigh Valley, Pennsylvania, we are joined by JC Parets, the founder and chief technician of TrendLabs. Before we dive into the conversation, gentlemen, just a reminder to our viewers that the views and the forecasts expressed are solely those of JC and his team at TrendLabs and based on their research. JC, we got the Fed pausing yesterday afternoon. I mean, there's a lot of good reasons there. Employment is steadying. The economy is strong. They're pointing out inflation. We've come a long way, but we're not back down to 2 yet. When it comes to inflation, what's the market telling you when we take a look at a record run for gold or silver and the long yields? What are the charts telling you?
Yeah, no, it's a great question, because for me, the economy is really not necessary to follow, because the economy, all that economic data, all that's lagging as an indicator, right? We want to look at the prices of assets. That is the forward-looking discounting mechanism that we know it to be. So don't worry about the economy. The economy will follow the prices of assets. What I find really interesting about the Fed is that interest rates literally stopped going down as soon as the Federal Reserve started to lower interest rates. Isn't that just hilarious how that happened? So, if you're wondering about inflation, I think about inflationary assets. I think about things like metals. I think about things like energy. When I think inflation, I think about real things, right? Not like the economic things, but like the real prices of assets. And historically, in these commodity super cycles, you get gold moving first and silver, and then you get copper and the base metals, and those things have happened. And then what happens after that? You get energy. So we've been getting long energy. I bought 2 more energy stocks yesterday, for example, some master limited partnerships. I think the kids call them midstreams these days. But back in the day, we used to call them MLPs, remember? So, I'm adding to energy. Energy continues to do well. And then again, sector rotation is the lifeblood of a bull market. Technology used to be a leader. That ended at the end of October. Technology has been a massive underperformer over the last 3 months. And look no further than energy. Energy, best performing sector so far this year, up 14% for January. 14%.
All right, JC, you always bring the charts. You want to start going through them. First one here is the 30-year U.S. Treasury yield and the effective federal funds rate. What story is this telling us?
I'm not a bank. Thank God. That sounds really boring. I'm happy that I'm not a bank. But if I was a bank, I would be interested in what Fed funds are doing, right? Because I need to borrow overnight and all that stuff. But I don't need to do any of that. I need to buy a house. I need to, right, take out a mortgage. Like, I am a human. I am, So I'm interested in actual interest rates, the 10-year yield, the 30-year yield. And they've been going up ever since the Federal Reserve started lowering interest rates. So these are two different things. So people are always wondering, oh, well, what's the Fed going to do? Who cares? Are you a bank? Why do you care what the Fed's going to do? It doesn't matter. We're interested in what interest rates are actually doing. We're interested in what the bond market is actually doing. And just yesterday, when you look at a relative ratio between energy stocks and U.S. Treasury bonds, yesterday and again today, we are at the highest levels ever. So if bonds are falling apart, that means interest rates up, energy up. And if you own energy stocks, you're making a lot of money. And I'm thrilled about it.
Okay, next chart here, and I love these charts. We want to talk about the U.S. dollar. Obviously, there's a lot of consternation, speculation, all kinds of conversations around the buck and where it's going to be headed after its recent weakness. People talk about investing in international names, getting outside the U.S. Show me this chart. Tell me the story about the U.S. buck and what it means for international investments.
I mean, I got to tell you, the positioning in the dollar coming into last year, coming into 2025 was extremely skewed. Asset managers and hedge funds betting on rising dollar, lower euro. And, we were taking the opposite side because, of course, when asset managers and hedge funds are piling into something, historically, it's great to do the exact opposite. And since we know that, that's what we did. But I'm not a futures trader, right? Like, yes, I could have shorted dollar index futures, I suppose, but that's just not what I do. I bring it back to equities. So when you think about, well, what's going to do well if the dollar completely falls apart and these hedge fund managers are wrong, as they usually are at extremes? Well, international equities for sure, emerging markets, Latin America, Africa, precious metals. If you drop it on your foot and it hurts, you buy it. Like, those are the things. Like, you don't need to be a brain surgeon to know those things. If the dollar's falling apart, those are the assets that tend to do well. And hey, as it turns out, those were the best performing assets last year. I can't believe it. So, for me, it's about the implications of a weaker dollar. Emerging market currencies continue to do well. Look at the Malaysian ringgit. Look at the Polish zloty. Just go, look at Chinese yuan, new highs yesterday, right? So these emerging market currencies continue to do well. So to me, that means a couple of things. Number one, international equities, massive outperformers last year. I think it was the widest dispersion amongst returns from U.S. stocks versus international stocks last year since 1993, right? So massive outperformance. And by the way, the S&P 500 had a great year. S&Ps were up 17% last year. Last time I checked, that's pretty damn good. But what ended up happening is that the U.S. was one of the worst performing countries in the entire world because all these other countries did so much better. And when you look at these cycles historically, these international outperformance over the U.S., it usually lasts 10, 12, 15 years, right? So does it have to be that way this time? Is the U.S. going to underperform for the next decade? I don't know. But how about more than 1 year? How about just more than 1 year, right? I'm not even asking for 10, just more than one. So that's kind of where my head is at. Yep.
All right, JC, let's bring the conversation back to the energy, because you've touted that, it's had a major outperformance this year so far. In a recent note, I think your colleague Sam Gatlin wrote that if energy is going to enter a new phase of outperformance, it has to be on the backs of a strengthening U.S. dollar. And that wouldn't be seen as a risk, but that's when energy tends to outperform or at least have some legs. So to you, what would the tape need to show you to validate that this rotation is underway with energy still having the legs to have some room up there?
Yeah, one thing about correlations is that they often change, right? Back in the day, energy and the dollar traded inversely. And for years, energy and the dollar were trading together. Well, come to 2026, dollar keeps going lower, energy keeps going higher. So this is the market signaling to us that it certainly looks like the correlations, the relationships between the U.S. dollar and energy are inverse. And then also remember, the dollar's a lot of things. Like, what is the dollar? Like, the dollar compared to what, right? So if you're looking at the dollar, compared to emerging market currencies, compared to the euro, I think that, the yen is a whole nother animal that we could go down that rabbit hole if you want. One thing as an intermarket guy, as somebody who trades equities, but looks at every day when I wake up, the first thing I look at is Forex markets and futures markets, even though I don't trade those. It's the first thing I look at. So as somebody who's very intermarket oriented, I've learned over the years the hard way not to overthink the intermarket analysis and trade what's in front of you, regardless of what the dollar's doing. I think energy could do well if the dollar's going up or if the dollar's going down. I'm seeing the energy index in the S&P 500 at the same levels that it was in 2008. And that was 18 years ago. So the bigger the base, the higher in space is how I learned it. And I think energy is just getting going already, by far and away the best performing sector in 2026. I think it's got legs. We've been adding to our energy exposure, again, regardless of what the dollar's doing. I think generally speaking, a weaker dollar is probably good for stocks, probably good for the bull market, probably good for stocks around the world, emerging markets. I think it's good for those things. As far as energy, energy is going to do what energy is going to do.
All right, that's the mantra to have. Bigger the base, the higher the space. So let's actually talk about like a little bit about breadth now, because we've seen S&P almost tagging its all-time highs now. It breached the 7,000 level. Now, some investors see that, for the S&P outperforming the equal weight index, when you look at it, as a sign of weak breadth. So when you compare it, and we've got the charts up, the S&P versus the RSP, which is the equal weighted S&P, how much of that gap is really driven by sector exposure, especially because, the S&P is heavily tech weighted versus true market health?
Yeah, I don't know where, somewhere along the way, people thought that like the equally weighted S&P 500 underperforming the market cap weighted S&P 500 is somehow bad for the stock market. There is no evidence of that at all. Like, not even close. Like, not even where you could point and be like, well, nothing. Zero evidence whatsoever. So I wonder why they're making these things up. It's so silly. When you look at these, the market cap weighted S&P 500, the traditional one that everybody always talks about that we own, is probably the greatest momentum strategy ever. It buys more of the best stocks and buys less or none at all of the worst stocks. That's a great strategy, right? that works. And so when you look at and then the equally weighted index doesn't discriminate. It could be the best performing stocks, the worst ones. It's going to buy a little tiny bit of all of them, right? So we know that that's actually not a good strategy at all. Actually, we have the data. But when you compare the two, right? Think about what's in these things. In the S&P 500, you got 35% tech. In the equally weighted version, it's less than half that. It's 16% tech, right? You got double the industrial exposure, right? It's very, very different setup. So what ends up happening is that if tech is in favor, if tech is a leader and an outperformer, then the S&P 500 is going to do much better than the other index with a lot less tech. And if tech is an underperformer, like it's been for 3 months, what do you know? The one with less tech is going to do better than the one with more tech. It's not a market breadth indicator. It's just sector rotation. That's all it is. Which one has more tech, and is tech in favor or not? That's really what it is. So we don't look at it as a market breadth indicator. It's really just, is tech working better or not?
JC, there's a lot of people out there that think we're just in the early innings of tech working better, that America will be, the centerpiece of this big AI revolution. So when you talked earlier about, U.S. stocks had a good year last year, 17%, and yet they lagged the rest of the world. If we have such a belief in AI and tech and it being centered in America, but you take a look from a technical perspective, was this a one-year anomaly when the world beat the States, or has this got some legs?
Well, that's the whole point. If it is a one-year anomaly, that would be very strange. Right? Like just 1 year. That's it. Like I'll bet that it's going to be more than 1 year. Right? I don't know about 10 or 15. I'll worry about that next decade. Right? But how about more than one? Right? And then as far as AI, I don't know anything about AI. I don't know anything about these fancy tech. Like I don't know anything about these things. But here's what I do know. Everybody agrees that AI is here. And these guys that are founding these AI companies are the smartest people in the world, and America's dominating. All the magazine covers in the world, Time magazine, all of them, parading all these CEOs around like they're the greatest thing since sliced bread, right? When I see that, I don't know anything about AI. I'm not that smart. But when I see that and everybody agrees that this is a thing, it probably ain't, right? And you're seeing these software stocks getting destroyed. Absolutely decimated, and I'm happy to see it. I don't own any software stocks. They're getting crushed, and it makes sense that these names are getting crushed when everybody just assumed that they were going to go up.
JC, let's talk about going back to that breadth conversation. As investors, we always want to look behind the rearview mirror see if there's any cracks sort of forming, beneath with when we're making these all-time highs. One space that you look at, or sector, I should say, is consumer staples. During a bull market is one of the, as you mentioned, one of the most consistent warning signs that you watch for. We know coming off of 2025, it was the weakest performer across the capitalization spectrum. But this year, it's a very different story. So what specifically is the recent outperformance telling you about the underlying investor behavior?
You got to tell you, and if you're bullish this market and you think that the S&P 500 is going a lot higher, the outperformance out of staples is telling you the exact opposite. So coming into this year, I'm thinking about what a basket of energy stocks and consumer staples is going to look like at the end of the year compared to everything else. And I continue to think it's going to look a lot better. Now, I don't know what's going to happen, but from a broader market perspective, continued outperformance out of consumer staples is consistently not a positive for the market. That is not a characteristic of a bull market. Last year, consumer staples were the worst performing sector in the market. That makes perfect sense. If the market's going higher, you don't want to buy consumer staples. You want to buy technology, industrials, banks. Like those are the things you want to own. Healthcare, biotechnology stocks. Those are the names you want to buy in a bull market. You don't want to buy potato chips and booze and cigarettes and condoms and toilet paper. Those are not the things you want to be investing in a healthy market environment. So if that's what they're investing in at the highest rate, at the fastest rate ever, well, I shouldn't say the fastest rate ever, but a faster and faster rate, that is indicative of money rotating into more defensive assets. And again, utilities, they can go up in a bull market. We've seen it before. They have a defensive tilt, but I wouldn't call them defensive. Same thing with real estate. I wouldn't call them defensive. Same thing with even healthcare. It's got a defensive tilt, but it's not defensive, right? Staples, consumer staples are the defensive group. And if they're your leader, that is not a healthy bull market.
JC, let's stay with the staples theme. We got another chart for us here. We are comparing the financials to the consumer staples. What story is this telling us?
This is a big story because we don't have bull markets without financials. We just don't. And, go back and study every bull market, and you're going to see that financials do well in those bull markets, right? And when it's a bear market, financials do terribly, right? And in the United States, that is certainly true. But when you look internationally, it's even more the case because they don't have massive tech stocks and all these industrials. They got banks in these emerging markets and in Europe. They got a ton of financials. So it's even more important outside the United States than even in the U.S. So if money's coming out of the sector that you need to participate to have a strong bull market and going into the most defensive sector, that is not a healthy characteristic. So if you are bullish this market, you're long the broader indexes, you think equities are going higher, that relationship of money leaving the banks and going into consumer staples is not what you want to see at all. Now, if you are bearish this overall market, you're shorting stocks, you think everything's about to fall apart, house of cards, whatever your conspiracy theory is, great. What you want to see is further acceleration in the outperformance out of consumer staples relative to the rest of the market, relative to financials, relative to technology, all those things, right?
Okay, let's talk about technology, JC, then. So, we've coming out of 2025, handful of mega cap stocks have carried the market. Leadership is now arguably changing to the small caps value. International still in the play. Max 7s are trading at their lowest valuation relative to the S&P 500 since early September. Now, if there is a rotation that's happening and let's just call it you're benching your all-stars, what does this tell you about a healthy bull market rotation, or is it the start of something more disruptive when some of these are not performing that really carry the entire market? We talk about a rising tide. This was the rising tide.
Well, these mega caps were part of what was working last year. They get a lot of hype because people don't do the work, but there was a lot of things working. Industrials have been working, financials have been working for a long time. Biotechnology was working, small caps were working. They just weren't getting the love, right? These mega caps were some of the things that were working, but with the positioning was at quite the extreme where last summer, these asset managers, these hedge funds that we know are the worst investors of all time, they had their largest net long position in the NASDAQ 100 futures ever, right? So there was nobody left to buy, right? And by the way, meanwhile, they had the largest net short position in the Russell 2000 futures ever. So that just had to unwind, right? And it's a mega cap story because when you look at equally weighted technology is hitting all-time highs. When you look at small cap technology, also hitting all-time highs. So when you look at technology is not the problem. The problem is the overexposure in these mega cap growth stocks, not just tech, but growth in general, right? Because tech, you got Microsoft, Apple, and Nvidia. But you also have Amazon and Tesla, which are not tech stocks. You also have Google and Meta, which are not tech stocks, right? You have all these things. Bitcoin is not a tech stock, but I would group all that in there and this, together. Tech has been doing fine. It's the mega cap growth that got too extreme in one direction, and we have seen that unwind everywhere else. So when you ask me, what does the underperformance in tech mean for this bull market? Well, if we get underperformance in tech and tech stops making new all-time highs, that would be one thing. If it's just these megas that are just not participating and everything else is, I think that's fine. So if you're asking about tech, I would look more broadly at equally weighted technology, small cap tech, mid cap tech. I would look at tech in general, because when you study every bull market over the last 100 years, I'm not that old. I mean, I'm 44 almost. I turned 44 in a couple of weeks. I've been through some cycles, but I've studied all the cycles beforehand. And one thing you're going to find is that technology is a leader and an outperformer in almost every bull market over the last 100 years. So technology leading is not bearish at all. It's perfectly consistent, with healthy bull markets. Tech was the best performing sector in America last year. And as long as on an equally weighted basis, small cap tech, mid cap tech, as long as they keep working, if mega cap tech keeps going sideways, I don't think it's all that bad. It's that if they start going lower and dragging the rest of the market down, that would be the problem. We haven't seen that yet. We could. We'll see.
All right. Well, look, happy early birthday to you first, JC. Let's talk about the Nasdaq then. Let's talk about tech, because you did an interesting sort of analysis, maybe a contrarian view a little bit. You talked about continuation patterns. They usually resolve higher. It's marked by lower highs and higher lows. And when they fail, they can have big consequences, violent consequences, if I were to say that. Now, you've noted that the Nasdaq right now is forming what looks to be like a continuation pattern. We have a telltale symmetrical triangle or continuation pattern, whatever you want to call it. But you also compared it to a previous study on TLT, which showed you that a breakdown of that and what that could result in. So what price behavior would tell you that we're no longer in this healthy consolidation, but it could lead to that failed continuation pattern instead?
Yeah, I mean, listen, the cool thing about markets is that, markets evolve. You have the decimalization of equities, 25 years ago. Options trading started in the 1970s. You had the SEC come in the 1930s. You got crypto over the last decade and a half or so. Like, there's an evolution in markets. The one constant is us. It's the humans. It's the human beings. I've been there since day one. They're still here. They're going to stay here, right? So you better get used to it. And humans really act irrationally during times of stress. And certainly this day and age, when our human stress levels elevated, when there's money involved. So the market exposes that for sure. So these patterns of fear and greed repeat over and over and over again. Study what the patterns and what the market looked like 100 years ago. They look exactly like they do today. Exactly the same, because it's the humans, right? Or the robots being built by humans. But it's the humans at the end of the day. So there's a lot about the market that we don't know, right? Particularly about the future. But one thing we do know is that asset prices trend, right? We know for a fact. So when an asset class, a group of stocks, an individual stock is in an uptrend, there's a much higher likelihood that it's going to continue higher than for it to completely reverse. So when I see technology in obviously a strong uptrend, mega cap technology, consolidating sideways for 3 months, the higher probability outcome is an upside resolution out of that digestion of those gains. That consolidation should resolve higher in the direction of the underlying trend. But if it doesn't, that is the market signaling to you that there is a big problem. And that Treasury bond example from back in 2016 is a great example. Treasury bonds were ripping, interest rates were falling apart, everybody thought rates were going to go to zero. Bonds should be breaking out. Well, guess what happened to bonds? They did not break out. They actually resolved that consolidation lower, and they completely fell apart. And I got to tell you, this consolidation in the Nasdaq and in mega cap tech, for that matter, looks exactly like that Treasury bonds did in the summer of 2016. Again, understanding that the higher probability outcome is most definitely an upside resolution, but I'm aware enough to understand that if that is not what happens, look out. Look out.
Okay, JC, we've covered a lot of ground here. Tech, energy, consumer staples, the dollar. You've noted, though, that real market stress and often shows up in credit first. So you're watching spreads right now. What are you watching for there that starts to tell you that there's something bigger that could be going wrong?
Yeah, the stock market's a tiny little thing compared to the bond market, right? The bond market's the big bully in the room. These are real leveraged assets, the biggest institutions in the world. This is the playground that they, hang out in. And so if there's real stress in the market, you're going to see it in credit. There's no way around it. And when you see the spreads between junk bonds and treasury bonds widening, that is evidence of stress. That is investors demanding higher yield for the junkier bonds. That's just kind of like saying high yield bonds, right? It's just a nicer way to say junk bonds. But at the end of the day, they're just junkier bonds. I understand corporations don't like you to refer to their fixed income assets and bonds and debt as junk, but we're all adults. It's what they are. So if investors are demanding a higher yield, particularly relative to the government guaranteed yield, and those spreads are widening, that is evidence of real stress in the market by players that actually matter, right? Not Joe Schmo in the corner retail investor. He could blow up 100 times. It's not going to impact the market. These are real institutions with an ungodly amount of money in the market. And if they're blowing up, that's a big problem for this market. So when you're seeing these spreads widening, that is a problem. When they're narrowing, that is evidence of healthy conditions, which they've been doing until now. So I'm really interested to see. So if you compare, let's say, the HYG, which is the junk bond ETF, relative to the IEI, which would be the same duration of U.S. Treasury bonds, so you're comparing apples to apples. If this line is going up, that is evidence of a healthy market. There's no stress out there. If this line's going down, that's a big problem, right? You saw it actually at the beginning of last year with the S&P 500 making new highs into the first quarter and these credit spreads starting to widen, this ratio starting to roll over before the market corrected. So we haven't seen that yet here, but that's definitely something to keep an eye out for. Staples outperforming, credit spreads widening, tech breaking down. These are the potential cracks that I'm seeing out there that I would look for as evidence that the risk-off environment of 2026, which would be pretty typical of a midterm election year, is here to come. By the way, February, also one of the worst months for the S&P 500 historically. Also, and I don't know if you checked the calendar, that starts on Monday.
JC, I forgot how much fun it is to have conversations with you and how enlightening it is. I hope you'll join us again on the show soon.
Happy to do it.
That was JC Parets, founder and chief technician of TrendLabs. And just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only. It should not be considered investment advice or buy, sell, or hold recommendations. Hearing where to start. JC laid out a lot of stuff for us, a lot of things to think about. Right there at the end, right? He just gave us this checklist of, like, if you're watching the consumer staples and money moving out of tech, and bond yields, and spreads starting to widen out, that those are signs he's looking for. But there was so much in that conversation. I think I could probably watch it 10 times to get something fresh out of it.
I know. There's so many juicy bits that you could chew on there, Greg. But, one thing that I wanted to focus on was the tech space, right? I think we were so narrow in our view of looking at just the mega caps really dragging the entire market up. But, his view is, like, if you look at the equal weighted, the Russell, the technology on the NASDAQ side, then they're really starting to take more of that weight on and really rising with the market. So it's not a story about the tech unfurling. It's just maybe of the mega caps sort of giving some of those, letting the other players come to the foray and really shine there. And then energy is another one, kind of surprised me. They did a study that said that it was, the dollar and energy seem to be very intrinsically connected. But we know that narrative doesn't play out these days. correlations are dislocating traditionally what has been in the past. And we're seeing that with energy. Energy starting to outperform. Dollars remain weak. It's most analysts are expecting the dollar to remain weak as well. And that's just another sort of tailwind in energy's sort of space to see what that outperformance could lead to this year. But I think the thing I'm still going to take away that I mentioned to him was higher the base. The longer the base, higher the space there for the run up there. So you want to look for those quality moves that are really hammering out the bases and have some room to run there.
Yeah, great conversation. Definitely rewatching that one again after I got to do another show at noon, but I'll find some time today. If you at home have a question for our guest or team, here's how you can get in touch with us. Email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website, where you can try out the platform risk-free. Just open a practice account by clicking on that Try TD Active Trader button. Then when you're ready to switch to a live account, simply export your workspace and start trading for real. All right, it's time now for Hiran to give us his technical take on what he sees happening out there in the markets here. And you got two things for us. We're going to start with the U.S. buck.
Yeah, let's start with the Dixie. Greg, dollar sign DXY is what we're looking at. This is the U.S. dollar index. Remember, this is the buck. When JC mentioned, you want to have context. What is it measured up again? It's the 6 sort of global currencies that it's paired up against. It heavily skewed weighting towards the euro, and then second, or heavily weighted, is the yen. And we've seen some of those news making the rounds this week, making a bit of a splash, and that's really added pressure to the U.S. dollar. And it's actually comical if you think about it. You've seen a wave of crisis of confidence narratives in U.S. assets at the exact moment when you have the S&P 500 that is testing all-time highs, broken the 7,000 level. You have, on the macro front, you have GDP running a 5 handle, so we're really, full throttle on the GDP. And then you have the U.S. dollar, which is now hanging near a 4-year low, around that 96 level, really on Fed independence concerns, but also the economic risk or physical irresponsibility of the U.S. Now, this week, just to sum it up, we had multilateral intervention between Japan and the U.S. There's this talk about this rate check that's happening. That's essentially the Fed, Japan reaching out to the Fed to see if they can prop up the yen, and the New York Fed had reached out to banks to see what the rate on large currency orders for the yen would be. Now, it's just sort of verbal, nothing concrete, but it's probably just a signal that tells the market there might be intervention. But we just saw some of the comments coming out, at least out of yesterday, that there was, Scott Bessent said there's no plans on the U.S. stepping in to intervene at that point. But anyway, that news had shaken up the dollar, brought it to its weakest level. Donald Trump's on the hitting the pavement with the primaries just at the end of the year, and in fact, he had mentioned that he wants a weaker U.S. dollar to pursue policy that promotes U.S. manufacturing and exports. Remember, weaker dollar makes U.S. exports cheaper, which means it's going to be more competitive in the global landscape of things there. So when you look at it all as a combination, you've got bonds, you've got currencies and metals all starting to move at once. The market is telling us something fundamental is shifting, and that's what we want to keep an eye on, and that's why we have a close eye on the U.S. dollar. Let's actually look at the charts, though, Greg. We can see that story. I've got the daily chart pulled up on the Dixie. We've seen it. A similar story unfurl, like it's still on a significant downtrend. When we did the monthly one, I don't have the monthly chart up, but it's recent price action here. You can see we just broke below the 96.30 handle, which is seen as a support because we've tested it on a few occasions. We came and tagged it back in the summer last year, came close to it, tagged it, didn't quite touch it. We bounced off of that level. And then in the fall, in late September, we hit it again. It didn't intraday tag, but it didn't actually close at that level. But this week, we did have a close at the level. And in fact, just below it there, you can see this primary candle on that Monday or Tuesday. We saw that really big bearish candle that folded, this bearish engulfing candle. And since then, we've kind of just traded in between them. This is a significant, selling pressure that's happening. Now, today, we are seeing it just, peak above that 96.30. The 97.50 is still the overall hangover, but the key level is still the 100 to recapture the 100. But, with the weakness that we're seeing and with the momentum, you can see the RSI, it's corroborating. And so we're in oversold territory. If you look at this RSI, Greg, we haven't been in oversold since the Liberation Day tariffs were announced. And this is the first time we're in oversold territory. It's just peeking its head above that level, but it's still very, very much in a bearish momentum play right now, especially with the MACD also confirming that same story here. So this is what's at hand and how this is going to look. This is really also a feather in the metal space, though. Remember, a weaker dollar is going to buoy up those metals, so that's really at hand when you're seeing that outsized move with gold and silver. It is also on the backs of a weaker dollar there.
Yeah, pretty important chart there, the U.S. buck. Another important name next week will be AMD, because we're wondering about the health of the chip makers. We put each one of them under the microscope, and you're going to put it under the microscope for us. What do you got?
Yeah, we are. Yeah, AMD, Advanced Macro Devices. This is a nice little fact I want to bring out. But the CEO, Lisa Su, is actually like a distant cousin of Nvidia. They're they're the closest rivalry, Jensen Huang. So it's good to see like kind of a family affair happening. It's almost a precursor, in fact, to what the big awaited earnings will be, which is Nvidia. So AMD is set to release their report on February 3rd after the market close. This is going to be the Q4 25 report. EPS expectation is $1.32. That marks a 26% year-over-year gain. And on the revenue side, it will be $9.67 billion. Again, 26.2% year-over-year increase there. The big story that investors will want to be hearing for is two things. Obviously, it's back to the AI, but also remember, AMD made its name in gaming processor, and that's further going to support the high expectation for higher sales and profits. On the CPU side of things, AMD has said that they're nearly sold out of server CPU capacity through the end of the year. And when you combine that with Intel, who just reported last week, which is saying that they can't ship server CPUs to data center operators, that just means that this is another tailwind in AMD's earnings, hopefully coming into this quarter. We also had, on the semi space, South Korean memory chip maker SK Hynix said it would increase its capex, and Dutch chip maker ASML also announced that they were almost doubling their orders from what analysts had forecast. So you've really got that as a tailwind. And then the other big news that investors want to hear in this earnings is the big deals that they've signed. They've signed up with OpenAI to provide them 6 gigawatts of data center capacity. They're on deck to do a gigawatt order from OpenAI in mid to end of this year. And then they've also got a 500 megawatt installation for Oracle. And then there's rumblings about a possible third partnership with hyperscaler Meta as well, that we might see if there's any sort of concrete information that they'll send out there. So this is the sum of it all. We've got the chips. NVIDIA just had the green light now with the H200 chips to China. That also means that AMD has chips that they sell to China, which we could see a little bit of commentary coming out from there. But when you look at the charts, you can see a very telltale story. We've seen again from the Liberation Day a strong uptrend. We did see it kind of buck that trend and kind of go sideways or consolidate for a bit, kind of hammering out a base at this level. Close to the 150-day moving average is what we have over here, but it's squarely coming out of fall. It had a big push up, momentum push up, and you can see this big runaway gap. This is one of the risks I do see in the charts though. Anytime we look at technicals, we want to see these big runaway gaps, whether they actually have legs. Remember, Greg, what we do say about gaps, they tend to get filled at some point in the charts. And on the downside, you've got this 160, 180 level. That's really the area of fill that it needs to have. But right now, we have seen a sort of rounded bottom pattern forming. So it did tag these highs on its last earnings that it came out of, breached these highs at the 265. It's really this is the key resistance level. Hasn't been able to break that. It's knocked on it a few times over here, but we formed this telltale rounded bottom pattern, which means this earnings could be the catalyst that pushes it up. Right now, it's just sitting between that 240 to 265, just drifting between there. But the expected move coming to this earnings, Greg, we're looking about, I think, $11 to the top side, which could mean that it could well clear that 265. But on the downside, that risk does remain closer to this 225-ish level based on where it's currently trading at the 246 at the moment there.
All right, we got the chart up on the screen. That means Hiren's going to walk us through a couple ways you could trade AMD. Before we get started with that, I just want to remind our viewers that options trading does carry a high risk, may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. So walk us through it. You want to start a bear or bull? Hiren's choice.
Let's start with a bull trade, Greg. Yeah. I've kind of teed it up what the expectation of the market is over here. So let's start with the bull trade that one could do. Now, looking at the charts, I'm going to just kind of hide this for a moment. So one of the ways you could do it is if you're sort of cash strapped and you still want to play, AMD, it is a pricey stock. You could do what's known as a synthetic long stock. So you're really mimicking owning the stock, but through the use of options. And the way you would do it is essentially looking to buy a call option. So we know typically when you're call, you're bullish on the stock, you want it to go up. In this case, for this trade, we're looking to buy, which is near or at the money, I would say, the strike, the 250 strike. We're going out to the March expiry, so give us a little bit of time on our sides for the price to resolve, see if it has some legs for the market to participate as it digests this earnings. And on the other side of it, to really make it to give it that sort of mimic a stock position, we're selling a put, and I'll explain why we're doing this. We're selling a put at the exact same strike price as we're buying the call, which is the 250. We're keeping the expiration the same. Now, the combination of what this does, Greg, and the reason we want to do this is it's something known as deltas when it comes to options. Deltas really help us track how much a option moves in tandem with the stock's move. So it's a measure by every dollar of a stock move, how much is the option moving. And because we're doing a synthetic long, we want it to exactly move the same way or behave the same way that the stock would. So this is why we're doing this combo. Now, if you add the two deltas of these trades, the call and the put or the short put, what it gives us is a perfect 100 delta. And if you were to attribute deltas to a stock will always have a delta of 100 or 1. In this case, this is what we're looking to create is a 100 delta position, and this is the way we do it. So essentially, we're still looking to get some upside move. It is a directional play. It is a debit trade, so we are spending money to it. And this is the other benefit of this trade is because it's earnings, the options tend to get expensive due to the volatility. But by selling this put, we're reducing our cost. And so right now for this trade, we're paying $4.25 to put it on. In other words, $425 on a single contract, which means our break-even price is at $254.25 there, Greg.
All right, and I know you got a reveal for us well in terms of potential risk and reward.
Yeah, let's do the reveal. So let's talk about what do you stand to gain, what do you stand to lose. So looking back at the profile of AMD, implied volatility sitting in that 39th percentile, which is not I wouldn't say it's very, according to its historic moves, it's not very high. You've got the expected move in this earnings for this week or next week, I should say, at $11. So when we are looking for directional play, we do want the stock to push up. We've got to break in at 254.25, so we want that stock to at least break that level before we start making money. Now, the max profit is actually not quantifiable because generally whenever you just have a single call, Greg, the theory is that the stock could go, sky's the limit. There's no sort of ceiling to it, but really it's dependent on when you decide to close the trade. So for that reason, we do say it's unlimited profit potential if it can break to the upside over here, as long as it goes beyond our break even. The downside is where the big risk is, though, in this trade. So the downside is if the stock doesn't, break above that 250 level, stays where it is, we do stand to lose, first of all, what we spent on this trade, which is the $4.25. But it's not only that. We are going to have significant downside risk on the put side. So as the stock falls, we will incrementally lose for every dollar the stock falls, equivalent every dollar in our loss. Now, the worst case scenario, Greg, is what if AMD just goes to zero? If apocalypse happens, then you got a total loss of $254.25. So that's your cost plus the total wipeout of the 250 down to zero. But also keep in mind, because we're short an option, it means you have assignment risk. That means if it does go in the money, meaning AMD goes below 250, we could be put the stock. In other words, we would have to buy AMD at 250 a pop, and that's 100 shares on a single contract. So that's another risk that does loom large when you're holding this position here.
Okay, so that's the bullish trade, the risks and the possible rewards. How about the bear?
All right, let's do the bearish trade. So again, we're going to play on the same theme of directionality. And again, the reason I want to do this directionality trade is because of the volatility profile. So if you are of a bearish inclination, one strategy you could put on is a bear put spread trade. So here what we're looking to do is we're looking to gauge kind of where are some of the key levels. We can see recent price action. The 240 when it dipped below was kind of a resistance before. It's kind of acting as a support, but if it breaks that level, we could see it kind of come down, almost testing this 220-ish level where it's found some area of demand coming back into the market. So this is where we've priced our options at. We're looking to buy the 240 put. On this case, we're going to go a little bit closer into the life cycle of expiration, 27 February in this case. And we're looking to sell further out where we feel the next area of buyers could step in at the 220 level and sell that put over there. All in all, this is, again, a debit trade, so we're spending money on this trade. We're spending $6 on this trade, in fact, and that means our break-even level is at the 234 level. So we need the stock to fall, but we need it to at least fall beyond 234 before we start getting into our profit zone over here, Greg.
Okay, do you got a reveal for me on that one? I feel like the screen was starting to pop up a little bit there for me.
Let's do this slow reveal here. So now in this trade, we do have actual defined losses in this trade and defined profits. That's what really the spread trade is, especially during earnings. You want to protect yourself. So if it does move the way we want it to, max gain is going to be, we take the distance of the spread, which is $20 in this case I've marked up over here. That means the spread would be fully worth $20. We have to just subtract what we paid for the trade, which is $6. And in this case, we end up making $14 or $1,400 on a single contract if it can get down to this level. Now, if it doesn't get down to this level, of course, and stays above 240, remember, AMD's trading at 244 right now and just stays above where it is or stays put, we are going to lose essentially what we put into this trade, and that's simple enough as going to be $6, in other words, $600 on that single contract there.
All right, some ideas for our audience to do their research on. That is the show for this week. As always, investors should perform their own due diligence before engaging in trading. We'll be back on Tuesday with Active Trader Live, and I believe we're debating the alphabet, isn't it?
It's the alphabet, yeah, Greg. Google is what we are going to be debating. I didn't forget it this time. I just jumped ahead last week, but it is alphabet indeed. We did an old school sort of coin toss virtual one this time. We'll do the big reveal on Tuesday, however, to tell you who's got which case for alphabet. So that'll be an intriguing one as well, especially coming out of earnings there.
You're just a man ahead of your time. You're very forward-looking here.
That's what I like to think.
Okay, another great show. Thanks for watching, and join us on Tuesday. Join me at noon on Active Trader Live, too. No, this is Active Trader Live. Money Talk Live. It's getting confusing.